All right, guys, it's Tuesday at 11, so you know where to find me. I'm joined by Peter, who's going to come on and do a little presentation. Before he does that, just a quick recap of the week. Vaccines, they're priced in that they're going to happen. So there's maybe more chance of negative news than positive news for that. It's really hard because it's uncharted water. So it seems like the optimism and the rally and the strength is due to that. They're already pricing in the stimulus going to get done. So again, I think there's a chance that they don't get it done. I think they got till August 8th before they go on recess. Who knows? I won't be surprised either way, but that can move us. Earnings, big day on Thursday after the bell. All these FANG stocks are all on the same day. Apple, Google, Facebook, Amazon, all Thursday after the close. I think it's foolish if you're not in front of your screens for that. And then the FOMCs today and tomorrow be less important than it was in previous meetings because they're pretty much going to say, again, I think the risk is that they're not as dovish and friendly as they could be in either their statement or Powell's press conference at 1 and then 1:30 tomorrow. So one's the statement central, 1:30 is the press conference. So those are important things this week. So now let's move into I haven't done like a edge guy interview type thing, and I'm not going to make an interview. Peter's done really put together some notes and went above and beyond when I'd asked him to share some things. And so he's been in the edge for a few years now. He's done, I think, a previous Tuesday coaching session a few years back. He's in the team room, and a lot of you guys know him. And he's a Illinois resident, and I kid him that he is the second smartest guy in Illinois, but I'm really not kidding. And then Ed comes in, and he's in Southern Illinois, and he's kind of navigated to be number 3. But Peter's been around a long time, great trader, and like I said earlier, even a better person than he is a trader, and I've gotten to know him. So. Isn't that nice?
That's
He's
nice.
blushing. All right, Peter, take it away, buddy.
Hey everybody, how y'all doing? Hope everybody had a great day, having a good month. And so Anthony asked a couple days ago, asked me if I would put together, or basically if I would talk for a little bit on something, and I came up with the idea. Well, scaling is something I like to. I think something maybe we all could use a little bit of discussion around, a little bit of work with too, because we're always so hyper focused on getting into a trade, and then we can't wait to get out of the trade. And I hear that in a lot of voices in the room when I talk to other traders. I hear from them. They're like, I'm already out. They didn't have anything left in the trade, and it still continued to run, and it gets kind of frustrating to figure out where to get back in. So I think personally, this is probably one of the hardest things to master, and I'm not even sure you can actually really even master this. I think all you can basically do is try and get as much out of a day as you can, because we never know where the next tick is going to be. And we've got we have some techniques on entry and how to manage that and be consistent with entry based on not knowing that. But you never know how the upside, and the upside is really where the advantage is. Once you're, or downside if you're short, and this goes both ways. I'd probably talk a lot more of it in terms of upside because that's really what I'm most comfortable with. But I know that we all leave a lot of money on the table, me included. So I just got a couple thoughts about how I approach scaling to help me kind of stay in the game as long as possible. Because when you have something on as a winner, you really want to ride that, and that's a cliche, right? We've heard that. I hear that on CNBC, Bloomberg. People talk about holding out to your winners all the time. But when do you got to have an idea about how to do that. So I got to put together a couple ideas on that. So let's go. I only have like 3 short slides, so we'll talk a little bit about those. All right, so I look at it as a method. So scaling as a method. So it's three broad categories. You got risk and scale, manage. On risk, I'm going to talk a little bit about size, a little bit about entry technique. I'm not going to talk a lot about entry technique, just highlight some of the things we know. Consistency, and then on scale, why are we here, how to protect, how to stay engaged, and then manage your stops, your scaling, and your runners. All right, so this actually is it's gonna be this the last chart, and it's the one we're gonna talk through. And there's a lot of things that happened this morning. This is actually from early this morning. It was after it was after 6 o'clock. Let me double check something on here, make to get exact time, so you can go back to it if you like. Yeah, it was. So this spike down here, this was at 6:30 this morning. Okay. Um, and I was at my desk. I'm typically at my desk sometime around 6 a.m., 5:30, and this was kind of how my morning started. So when we look at risk, the first thing I want to look at when I see anything going on here is, you know, what is my risk? And one of the things you probably need to do, if you haven't done so, is go back and listen to Anthony's size video. He did a great size video some years back. It was one of the first ones that I listened to. And it's how you basically build size in a trade and how to do it in a way that you train your mind, you train your muscles. Because it's really, really important. Your size is going to be what helps you stay in the game. And also can be how you exit the game too. But you want to definitely be greater than 1. If you're not greater than 1, then you're going to run into problems. Um, and that's really, I think that's kind of somewhat logical. But you'll see that if you only trade in with 1 contract, you're going to need to have a lot of trades every day, and that's probably not going to work out real well for you, because a lot of times these are all, you know, they're probably more like 50-50 propositions. Any trade is. We get a little bit better than that because we use some genius, but you need to be thinking more like, well, where am I going to be wrong? So this morning, this happened here, and this was interesting. You can see how these things, this kind of comes down, and it forms, if you do these numbers here, it almost kind of forms like a pyramid. So you almost have a pyramid shape right here. And what happens is you then see this 4 come in. So we just lose all interest in selling. There's nobody else that wants to aggressively push it down. And so the market does start to go back up. So we get that rebound. So we go on up. And then we get this area up here where I don't really want to go any higher, and it comes back down. So one of the things you want to look at is what's kind of this distance here, right? So how much risk am I going to have? So we got these 18 halves down to these 17s. I need to change the color here because it looks like I'm on black. Here, let's change it to, oh, what's a good color? Oh, how about green? All right, there we go. So, you know, so you know your risk. The way I define my risk is down in here. Okay, so Dave, this is off of Dave's. You can see this is very familiar. This is Dave's zone. So this is also very beneficial. We see a zone here. What we need to understand is you know, where's the risk and how do I want to size this trade? So as this goes along in time a little bit, you can see we're still getting these zeros here, you know, all this low stuff here. And this is just common order flow. It's something we've all seen with footprint charts. And this to me is a great setup because it's showing me that, one, there's an area here that I can't attract any more selling, and people are buying it when it comes down into this area here. You can just see that. You see the 111s, the 114s. Some of these intermediate bars here are small. That's actually kind of important. You start to see some of these intermediate bars on a sideways move as the market's going sideways. You start seeing some of these in-between bars getting really small. That's an area where there's probably some confusion. I call it algo confusion. So algos don't know really what to do in that area there. So what generally will happen was you'll start to get maybe another little push lower. You can see this box here, and then you'll get the move higher. Okay, so your entry's got to be somewhere in here, wherever is comfortable between you and your mouse. But you know that your risk is down in here, right? So you got to know that. So what you're doing here is you're kind of doing this is what we call that retracement trade, where it comes up here and it goes down some ways, right, sideways, and then goes higher, right? So this is the retracement down into this area here. And then what we saw, there was no more interest in selling it. Let's see where I'm at in my notes here. So what this also what you can do too is there's another video that I'd encourage everybody to take a look at, even if you have, it's been a little while. Is Anthony did a Ready Aim Fire series, and that's kind of what happens here. So you see coming in, you're ready. You know you're ready when it comes down into here because you have a technique, you have a retracement technique. You're looking for a sideways move above where we previously went down, and you get your aiming point, and then you're firing someplace in here. Okay, And you have to qualify that. Well, you either use the order flow that we have in here. You can look at Dave's chart. You know, Dave Metters in the morning, or he's got this up and running, and there's a you know, there's a market by order information that comes in. And then you have your own individual qualifier, whatever that may be. Maybe you're watching some sort of an ancillary that already started moving ahead of time. But you have to you have to get comfortable with the idea that you know you're going to be wrong under a certain level here. So this is your opportunity to get in and participate. All right, so in doing this though, you want to basically be, you know, you have to be consistent. You have to get to a point where you're able to do this, you know, out of 10 times. This has to work for you like 6 or 7 or 8 times. And that's the consistency. And so you have to kind of believe that, because this is not always going to work. Sometimes this is going to continue and it's just going to drop down. It's going to fall through here. But you know that if you go underneath this level here, or maybe a couple ticks underneath it, that that you know you're wrong underneath there, and that's it. And then you're out. And you're out. So we'll talk about how to manage that here shortly. All right. So now let's get to the eraser here. And okay, clean this up a little bit. All right. So one of the things in getting to this point here too is you need to have something. You need to have a goal. You know, why are you here? Why are each of you here every morning, every day trading? You have to have a daily goal. All right. So we need a goal. All right. Now I'll be frank. My goal is a nice, simple 500 bones, $500 to $1,000. Okay. And this is a kind of a range because at the beginning of the month, I start out looking for this. And then towards the end of the month, I start looking more for that. Everybody needs to have one of these. I don't know what yours is. Maybe yours is another zero behind beyond this, or it's less than zero. But this is just kind of a general goal that I think you should have. And I don't think you're going to get there if you're doing 2-tick trades. So if you're coming in here and you're at least everybody should be able to see. They should be able to see the top up here, and you should be able to see a bottom forming down here. All right. Now, if you're playing for the move to go up here, and that's the one that we all want to play. I think emotionally, it's a lot easier for everybody, for traders to play that move higher, because you've already seen the market move and you want to be a part of that, part of the continuation of that. It's just unfortunately though, this was written by people that know how to play with your emotions. So a lot of times we'll do this, move down lower into here. And then I think this is where typically the best opportunity is, because I don't like these trades. These are the FOMOs, fear of missing out. I don't do a lot of those. There's a technique for doing it. Anthony does them really well. They don't work real well on the Globex, I found. They work much better during the day. So watch out for the FOMO trades. So we come down here into these areas here, and this is where you have the opportunity to get more than 2 ticks. Right? So if you're only going to do a 2-tick trade, it's going to take, you know, that's going to be $25 for one contract, and you know you have to do 20 of those to get to that 500. That's a lot of trades. And what do you think your chance is that you're going to execute 20 trades perfectly every time, or 20 times in a row? It's like flipping a coin. If you do the coin flip, are you going to have heads 20 times? Not likely. So you need to basically maybe look at trying to get more size. And so that's why I like to trade in what I call a tranche. Okay, and I typically break mine up into like a 3, a 6, a 9. All right, so using that earlier video I talked about, the size video, where I like to work on. Originally I'd worked myself up to 6, and then 6, and then 9, and then on. Okay. This then allows you to, as you're coming into one of these areas here, you can actually set up then a plan where, all right, so at like 4 ticks, here, let's say this is 4, all right, from my entry down here, okay, then you're actually taking your first piece of your tranche out. So you pay yourself, and you had something else down here called your stop. I'm going to get ahead of myself here. I don't want to do that. So the point here more so is you want to take out something at your first point, at some exit point, shortly after you went into the trade, so you can basically pay yourself and protect yourself. Go back to that other comment up here. You want protection. Okay. Then you can start to basically do things with your stops, and I use what's called an OCO order. OCO. Most of your FCMs, their DOM, you should have an ability to be able to enter what's called an one cancels other order, and that allows you to basically set up a plan. As soon as you're at order entry, your targets will go in and your stops will go in, and your targets can then be way up here, and you can make adjustments. We'll talk about that in a moment. All right, now part of this is the engagement part. Okay, so when engagement, once you get your order in, so you recognize that this is an area here, you got your order filled in here, starts to move up, you get your 4 ticks. What are you going to do with this right here? Well, you got to move this up. Okay, it's your stop, so you got to move your stop up, and then these are your other targets. You look back. We're always looking left because we can't see right, so we're always looking left, and so then you just have to start adjusting your targets to various areas where you saw things happening, like a crime scene, where like this here, I would call this a scene of a crime, where we broke down. A profile, like so we have profiles. Don't have a profile here, but a lot of times you see a profile, it's got a big bulge, it's got a little null area, another big ball or in a bulge. Okay, so these areas here in the profile are always interesting. So you'll see the market will try and move up into a lot of these areas, and then it'll move up and then it'll fall back. Okay, and then we move back up again. So you want to use these areas, depending on how you're long or you're short, to help place your targets. So not just using a 2 tick, a 4 tick, a 6 tick, an 8 tick, a 12 tick target. You want to be engaged with what's going on. So back up to that thought up here, engagement. Okay, you want to be engaged with what's happening once you're in your trade. I think that also does a lot for mental, keeping all those demons at bay, where once you're in a trade, you want to get out of the trade as fast as you can because you just want to get paid. This kind of keeps you in the game as you have a position on and you're working with it. And you don't take the whole thing off at just the first tick, the first 2 ticks, or first 4 ticks. All right. I'll come up here I'll figure out how to look at questions here in a little bit.
You know what? I'll ask you the questions like at the end, and we'll go back. But let's just take your time and go through it. So far, I'm following. If I could follow, everybody could follow.
Nothing rocket science here. I'm
No,
not gonna get the Nobel Prize for any of this. That's for sure.
But it's good because you're clear as to what you're articulating. Like that Ken Packard said, if you can't articulate it, it doesn't exist. So you're articulating what you're looking to do. The first thing showed you that it could be bullish. Now you're looking for a pullback and some flow to get into it. And I want people to know Peter's not going to tell he's not here to tell every exact moment of every decision. It's just, hey, ready, aim, fire. He's bullish, looking for a pullback, looking for some order flow to get in. And then what? Then it goes right into scaling. And that's what's important, how to scale so you could protect your position. All right.
Okay, last one, managing. Okay, so I'll talk a little bit more in depth about managing. So, again, using this area down here. Okay. Order goes in here at 19. Okay, and you got to have whatever your stop is. If your stop going to be 4 ticks, is it going to be 6 ticks? I'll give a hint. I use 6 ticks most of the time. Okay, sometimes I use 8, but most of the time I'm using 6. And then you're looking for your first 4. All right, so your first 4 ticks on that is this 20 up here. All right, so this is your first target. And then then I have other targets for the rest of my tranches, and they're just like 5. They're usually like about 5 handles away from each other. All right, so 20 was up here, 25. All right, and then there was another one. Let's say it was way up there. So what happens is you need to be, and I'm not the lucky guy to ever get this number or that number there. I'm always one of these guys that's getting this one area right here, is you got to have your stop somewhere below because you want to have you need to let the trade work a little bit. This is my technique. It may not be yours. I mean, if you're catching a trade up in here, you would definitely not wait for this area down here. Okay, up here you got to get paid rather quickly because you're at the top of a range. So I'm down here. My trade method here is a continuation trade. That's a trade. That's how I would categorize this as a continuation trade. I'm looking for the move to continue on. And so I know that this level here was kind of like my stop. So what I would do is I would move this down to here, all right, because I know that this is underneath here is where I'm going to be wrong. And I can do that because, in my DOM, I basically have a couple of different OCO strategies already predefined. And so I'll pick the one as it's coming down in here, which one I want to use, so that way I'm risking my as much as I want to risk, okay? Okay, so this area here is obviously the risk area. I mean, you all know that. I'm sure you all know that. But thinking about this though in real time, it sometimes can be a little bit challenging. It took me a little while to get comfortable with thinking like this all the time. And the way you can help yourself is by, if you have this stuff predefined, then you don't have to think too much about how much I want to put in. Or how am I going to manage it? Because it'll go in automatically as soon as you select the strategy and you hit execute, hit the buy. I don't usually hit the buy market. You hit on the DOM, a limit number. The order will go in, and then it'll hit. Usually, if it hits the order, then I get filled. I get, you see how the messages come off that you get filled. You start to get a little excited. Some adrenaline starts to build up, and then it quickly, if you're lucky, it quickly moves to your first target. It takes that off. So now once that's done, hooray, target hit, right? Right. But you don't want to take it all off, but you want to protect yourself. Now, so now you take this area here. What I do is I take that and then I move that up into here. Okay. Now you see it came back a little bit, but it stayed away from my entry point, and then it continued to move up. Now looking back, I took this and move it down to here because I know that this area here, there previously was some difficulty getting into it. So this target 2, right? So T2 got hit. Yes. So T1, T2, all right? So that got hit. And then you take your this and you move this on up to here, all right? Then the market goes by and it does this and trades over with, all right? Now, hooray, but I made 2 targets on that trade in the morning. Well, most people were still counting sheep, and I'm more or less done for the day. This came around. You could have taken this if you're ready for it. Quite honestly, it typically takes me a few more than just a couple bars to push the rest of those emotion and all that adrenaline out of my system. I didn't really get this area right here not until later. So that's kind of the idea for how you want to take stops. You want to move your stops, and then kind of stay engaged. You stay engaged by keeping these runners out here. You're looking left. You're looking at where there were previous places that the market stopped. It stalled. There was news. Was there news out? As the day's going on, I'm marking on my charts when a certain news release came out and what happened. Like all this COVID information that's going around, the stimulus, econ numbers like employment, Fed. I always take a look at where they first, what the market first did and that reaction, how far it went, and then how far back it comes. So let's just say, for instance, this was a Fed announcement here. Some Fed information came out in the market. A lot of times when the first news release hits, you get the jitter, and then you'll get a move. All right. And then where do you get in? If you're trying to chase this going up, I have found personally that it doesn't work real well. You have to typically wait for some area for the price to come back to some area, and this one did. It came back and down into here, and then you could have done something there. And same thing, you get in over in here. It sets up your orders, and then you get your targets above or targets below if you're short, and then your stop that would be up there, obviously. But that's just, that's engagement. That's staying with the trade. It's keeping you positioned so that way you are making money as the market is moving in the direction that you believe it's going to be, that it's supposed to move in. And by focusing on where you're going to put these, and maybe helps keep you in it a little bit longer, because you won't be so tempted to just hit the exit button and then and take the trade off, and hooray, you made some money. But did you make enough money? Did you make your day? Did you make your week? Did you make your month? I found that when I started doing this a few years ago, it became much easier to make a month, because typically you make my weeks pretty quickly, and then I can start to expand a little bit. So let me touch a little bit about what I mean by that, by expanding. All right, so I said before, and my typical, like say, looking for a day about, just say 500. All right, so for a week you're looking for about 2K. All right, and obviously for a month you're looking for about 8K. All right, you times 12, 12 months, right? So it's about what, 90, 96. Okay, so that's just a rough idea for, if you're just to get an idea for what is kind of like a potential, because that sets up really the next thought. And the next thought is, once you've achieved this, all right, you can start looking more at this. And if you've got 3 weeks left to go in the month, or 2 weeks left to go in the month, what you can start doing is, what I do is, I don't change anything in my approach. So this will still be the trade I'm looking for. All right, you look to get in here, you got your stops down here, you got your targets up here. But what I might do is I might say, and you keep this first target always, right? 1T, my first target. But the second target and my third target, I will move. I will move those, depending on how I'm doing on a month. So I may move this on up, and then I may do the stop, give myself a chance to actually achieve more, because I've already made what I say is a month. Or if it's early in the week and I've already made the week. I think that's one of the big differences that maybe separates me from some other people, is that I'll be a little bit more patient as the month goes on, and let the trades work for me longer. So then that way, the P&L, your P&L is going to be something like, like that. You'd be pushing it more like that, right? Get more, a little bit more here. So you want to try and get your average P&L to go that way. And so you need to think, for yourself, what is it I need? What is it that you need to do to get you to move this in that direction? Okay, and actually it should be actually a lot higher, right? Because this would be profit. All right. Hopefully that makes some sense. All right. Okay. How about some questions? I think I've confused people, maybe talked myself into circles long enough.
Here, no, what you're saying here, this is how I expand what you just ended with. And this is great and excellent, by the way. But if you're up a comfortable or amount or goal, I think what pushing out your target is like a exercise to see what it feels like to actually start being able to catch bigger moves. And the time to do it is when you got bullets in the chamber.
Yeah.
So the market doesn't know that you're up for your month in the second or third week. But what I think that you're doing is, this is the time to see what it feels like to stretch. You know what I mean? To find to build muscle memory to take bigger moves out of a trade.
Yeah, and so one thing I want to just emphasize is that this area here, this risk, you don't mess with that. Okay, just because you've made money for the day or you made money for a week and a month, you don't mess with this at all. Okay, if you're gonna mess with this, you're gonna get owned, because this is gonna slide that way. All right, because you're gonna when you're wrong, you're gonna be wrong by more, and then that's going to create other issues in terms of your own confidence level. When you see a move like this, you may be then inclined more so to want to short that, where clearly it's more of a long setup. Okay. or you're going to want to be more inclined to want to take it long right here. You're going to, let it go further because maybe I'm already up here. So don't get sloppy. So none of this here is a prescription to get lazy and sloppy. You have to constantly focus. This is the beginning part right here. This risk management, that's the building block. Then this helps you get to a point where you can be comfortable that you are consistent. And then once you're consistent, then you can look for these bigger moves and winners to help move your P&L in this direction.
Don't get lazy. I like that.
Yeah, I mean, I wish I could say I never do that, but I can't.
Well, everybody can. That's why you have to keep saying it and stay
Just have to, yeah.
focused on it. The next question is, you mentioned something about those that trade one lots. Did you repeat that? And I think it was along the lines to,
Yeah.
sometimes
So
you find making too many trades.
yeah. So what happens is, okay. So we did in the team room. One of our traders was talking a lot about two-tick winners a lot, and we did a quick little, just a back of the envelope, calculation on if you did just two-tick trades, right? So you're making $25 before fees, right? Before resort fees. So like with Interactive Brokers, I think that's like $16, and with some of the other FCMs, that's probably pretty close to $20 realized. And you wanted to. You would need more than 20 trades a day if you did that. So you'd have to be right 20 times. So if you're only good half the time, you would need over 40 trades. But even then, you'd be out huge resort fees. So you need more than 40 trades. You need like 50 trades, and so it's just a compounding problem. And so all we really mean by that is just that. How many trades do you want to make in a day? Okay, why are you here? Are you here to make? If you want to make 22 tick trades, then you need a system that'll allow you to do that. Okay, by being greater than one contract, then you can start to get engaged. So that way, you're looking at the order flow. You're looking at the news flow, you're looking at the econ, and you're doing this over a span of days. If you're engaged in the market every day, Monday through Friday, you're going to get a really good sense of where the market has had trouble getting through levels, where there's resistance, where there's support, where there's more opportunity that we're going to probably hold a level. So your odds are in your favor that we're going to hold a certain area. It gives you a chance then to get more of these 2 targets, 3 targets, and higher. So that's why I would really suggest go back to reviewing the size video. There's a thought process behind how you evaluate these. Like the one target, was that just a real simple? Yeah, it happened real easily, hardly any emotional capital. The getting to my second target, did I expand a whole bunch of emotional capital because it was really a really complicated trade? The movement was really jerky. Or did I take a lot of extra risk? Did I drop below my level here? I had to come all the way down underneath here, and then I went all the way up to here. And it's going to happen. That's going to happen. Like it happened here. But if you're disciplined, you'll get the opportunity where it'll go here, it'll go there. It won't go down this far. It'll go down maybe that far, or not even that far, and continue to go up. So you'll still be in the trade. I hope that made sense. Because if you only got one contract on, you're out. You're out at this point right here. And then what are you going to do about all this? Are you going to get back in right here? Maybe. And that's okay if you do. Because that was actually a really good setup also.
Taking 2-tick winners and only looking for 2-tick winners are totally 2 different things. If that's all your goal is, you're exactly right. Even more than 2 ticks, if you only look for 3 or 4 tick winners, and that's it, and that's only trade you're going to get, you're going to have to, as Peter said, make a lot of trades. And I like resort fees and replace commissions. That's great. So another question is and I kind of answered it, but I think your answer would be the same. But Ron asks, when you look for pullbacks and you've seen the zeros down at the 21.0, 10,
okay.
What's the difference between the 4.0 up ahead and that previous little pullback 4 or 5 bars earlier.
With
You
this
see
right
that?
here?
No, up, left,
Right here?
left, no, left,
Oh, they're
left,
here.
left, a little bit more left to the bottom. Right there. That
Right
bar.
here.
Yeah.
Okay.
Not that, and then the other one.
Right. Okay. This didn't come very far down. Okay. For one, this didn't come very far down. This one here too. Right. So that's actually, Ron, that's actually a really good question. All right. Because I didn't touch on that. And not because I didn't want to, just because I didn't. So this area right here, this 17 something or another was an area from yesterday. So yesterday, this area showed some support, and there were some things that happened in the tape yesterday that had this already qualified on my screen. So when it came in, let me go back to Globex. Yeah, I'm a full session already. So when this happened, it actually occurred in an area in the profile that was interesting. So that's kind of what made this really more interesting to me. And so what I would do a lot of times is I take this right here, Anthony, close your ears because you might not like what I said next. Maybe you will, maybe you won't, maybe you will, I don't know. But what I'll do is I'll draw a fib, okay? I'll draw a Fibonacci. I have a Fibonacci tool in my software, so I'll take a fib on here, and I'll come back, and it'll mark 50, okay? It'll mark 61.8, all right? And it'll mark 71.2, I think it's called, or 7.6, okay? And so I kind of qualify anything in this area right here as this is a continuation trade setup. So as we start to go sideways, I get real excited because I start seeing these zeros down in here, which tell me that it's probably gonna stay above this right here. I know I've got really tight risk definition, and then that's what kind of sets me off. So that's why that one's more important than what I thought that one right there is. Not that this one's not. I think this is actually, you'll see this work during the day more often than in the Globex, in my opinion. In the Globex, during the day, a lot of times, this is part of a consolidation move where this box, okay, but this box is going to go higher. All right, we're going to come higher out of that box. Okay, so this is fine if you were focusing on this 4, you needed to be getting in over here. Okay, is what I would say. Because if you're not getting in over here and you're waiting for way over here, I think too much time has maybe transpired, and you're not going to get this breakout box. That make sense?
Yeah, that makes. Are you guys still hearing me? Yeah, almost changed my mic. Not only it makes sense, but it was similar to what I answered because it's not a pullback. It's almost like you're playing the fear of missing out.
Hey, look at that. Who's the teacher here?
Do you use your full size in the Globex session?
Well, you can't because you're limited. So you can't because you don't have. I use some day trading margin too. So what? And I use an FCM. I use Dorman. I think I can say
normally trade. When are you normally done, Peter? On average during the day?
10, sometime between 10 and 12.
Those are good times to
Yeah.
be done.
So an FCM, a futures commodity merchant, will allow you to have day trading margin, right? And that is typically about 500 to, I think, 1,000, depending on where the VIX is at, volatility, per contract, okay? I know IB is a pain in the ass for some of my clients, so they are strictly the CME margins all the time, okay, day and night.
IB's too big. That's like,
yeah. So I mean, but some people need IB because that's, they want the safety and security of their
that's true.
of their where they're at with the like if you have a retirement account, you could. I mean, you can retire. FCMs allow you to open up retirement accounts. The problem with an FCM is you don't have the same protections with the government as you do with IB. IB is just protected by certain securities laws that your capital is more secure.
What I found is any FCM, once you have a history of how they see how you trade, they could bend certain things for you, especially if they see that you don't carry overnight positions, taking risks, trades.
Right. Exactly. And when we had the big down move in February, um, they I didn't get restricted much at all. I think oil was the big one that they were restricting on, and I think they did take the ES margin on a day basis to like this level, and I think they went as high as 2250 at one point when it was it was really crazy.
Right.
But that was it. IB was pretty much IB went as high as like 25,000 per contract during the morass, which was over three, which is basically almost three times what it typically is on what the CME specifies it as. So during the overnight, in the overnight, everybody reverts to this right here, to whatever the CME says that you need for maintenance. So you can't use your full size in the morning. And I'm not just so sure I would really want to, because you don't typically have all the liquidity that you have. So I'm trading more than three. Okay, I don't want to. All right, I don't want to put them all out there at one time in the Globex session, and then not that it would be illiquid and I would have slippage. It's just that it might be a little bit harder to get out of all of it right away.
Are you how many trades did you take a day, including pre-market, Globex?
So on an average, trades per day are less than 5. Okay, on average per day. At the height of the craziness, my biggest day was 20 trades. Those 20 trades.
So more volume in the market, more volume for Peter.
Yeah,
That's
exactly.
rule of thumb.
Yeah, basically.
It should be everyone's rule of thumb.
It should be. It should be. 'Cause you want to be smart about it. You don't want to be the one holding the cards, and then the market goes against you, and then you're like,
it takes a skill that you build to, like building actual muscle. You don't just start lifting a lot of weights before you lift a little weight. And so it's just like his ability to get more out of the move. You got to keep pushing. And that's why I love when the time to look for more is when you've already met some monetary goals. So the pressure, the time to do that is when you got bullets in the chamber, not when you're still looking for bullets. You know what I mean? That's
totally.
a great point of this webinar. Dylan asked a question. What about your size, keeping the same targets instead of waiting for further targets? I see. Thank you. And I couldn't understand. Maybe you could read that. You could see it too, can't you?
By clicking on chat. Yeah, chat. Okay.
Yeah. Dylan halfway down.
He's laughing.
Yeah. Now scroll up. I have trouble reading.
AP is 502, right? I got you there. Okay. Keep going for Dylan or?
Yeah. 11:35.
Dylan. Okay. Well, let's just keep the same targets for future time.
Maybe if you ask it again.
Yeah.
I guess what he's asking is, instead of extending targets, keep the same targets with more size. Do you ever think of that?
Let's say that again, Anthony.
Instead of extending targets, keep the same targets with higher size.
Sure. I've gotten comfortable trading the size that I trade, and I mean, yeah, I could do that. I'm not at a point right now where I want to increase my size more than where I'm at right now. So I think maybe at some point you do that. I think there's trading the ES market and trading the oil market also. I mean, these are very liquid markets. We can be quite large. And so, basically, it's really, I think it's just a personal choice. I'm comfortable with where I'm at size wise, so I don't want to upset that really at the moment. And
I agree.
By transitioning to as I moved my thought process to that more about a day, a month, and a week, a day, week, and a month, I got myself to a point where it was actually it was becoming, I don't want to say easier, but it was very, there was a certain kind of flow and rhythm to it, logic, where I felt like I was at the right level of engagement, and not that I was risking too much. And so I think you start getting too big of a size. So just for example, like you say, if I traded 50 and all of a sudden I don't want to double to trade 100, that's a lot more risk on that when you miss. Okay, and I do miss. I get my losses. I don't scream and jump up and down about them all the time, but I do have my bad days. I haven't had a perfect quarter yet. Someday I will, but I haven't had one yet. And so, down days hurt. And, you're wrong 2 or 3 times and you're trading some size, that's going to be a big number pretty quickly. That's going to build. So I think just from just to close, I think for psychology management, I don't want to be any bigger because I'm actually comfortable with where I'm at.
And that's what we found in a prop firm was, and my saying is, not everybody could trade huge, but everybody is equipped to trade bigger than one. We're not all wired to trade 20, 50, 100, but we're all wired to trade bigger than one.
Yeah.
As long as you go under that, you can find your sweet spot. And Peter found his sweet spot. We remember in a prop firm how our sizes were going down as we were having families. And it was like, that was part of the whole psychology of what we used to be comfortable trading and now understanding risk and thinking on that terms. And it wasn't a coincidence that we traded less big, I'll call it, or not as big, because all of a sudden we started, buying things and having kids. And then you get on the other side of that, where now you're going to maybe absorb and have an appetite for more risk. All that stuff matters in this business. And don't kid yourself about outside forces not affecting inside sources. And I would use the word affect. I had someone just comment on my verbal journal video I did, and I typed in there, I guess I must have typed in there affect instead of affect, and he actually put a comment. He goes affect, not effect, and corrected me. So I replied, thanks for your help, YOU apostrophe RE. But one of these guys, it has to be right. Anyhow,
So it's really up to each individual
That's right.
what they're comfortable with.
And then once you get comfortable, you don't have to get bigger and bigger and bigger. The whole key is to get bigger than one and then get comfortable.
Think about it. If you don't have to trade a lot to get these numbers, okay? To get, if your day target, it's kind of funny that the margin interval is similar to the day target. I'm sure somebody thought about that too when they came up with that. As they designed this game. It doesn't take a lot of size to get here, and does not take a lot of trades to get there. If you're like 70% consistent, you get like a 70% hit rate.
Right.
Loss ratio is like around 70%. That's actually really good. You should be able to get 500,000 without much of a problem.
I think that as I read some of these comments, it's the same thoughts I'm having with your process. If you could articulate your process, you have a better chance of being consistent. If you have a better chance of being consistent, you will be. And then you could work on and tweak stuff if it needs tweaking. And then he starts working on taking the size you're comfortable with and looking for bigger goals, targets wise, when he's up his goal. I think that's fascinating because the market doesn't carry you up your goal, but you're working on lifting more weights in a sense, right? Not building your size, but looking to take something more out of a move.
Yeah, I think Dave mentions it every now and then. His feet up on his desk moment, or Captain does,
Yes.
or Carl even does too. And that's kind of what happens is that you get what could be better than being long from down around 13, 14 today, and seeing us up at 30, 28. Do you have to take your last tranche off right now if you're at this point in the month, and you've already made your month and you're working on next month or the month, next year? So you can just sit back and relax. I'm not saying you have to. That doesn't turn you into a swing trader. I'm not suggesting that. I don't carry positions generally. It's very rare that I'll carry something in overnight. Even if I caught a runner that just kept on going, I got my last tranche on, or I got a couple of tranches on, I won't. I will generally I will take it off at some point. But there's nothing better than at noontime, it's sitting right here, and then you go out and do your workout, or you go do some business, whatever you need to do, and you come back later, and it's another 15 handles higher.
time, know when to press. I
Yeah, it's a
remember
lot of
going
fun.
to a nephew who was younger. His bachelor party was at a riverboat, and he was watching me play craps, and I was up. He was counting my chips, and he didn't gamble much, and $300 was a lot of money to him. He was in his mid-20s. He said, "You're up 300. Why are you betting more?" I said, "This is the time to bet more. This is the time to press. Not when you're down 300. And then if I can't, double it or get
Exactly.
this up to a certain amount, then you pull back." But I had my feet up on the desk type of moment where I could press a little bit. So and that's gambling that with no real edge to it. But yeah, I mean, all these things are helpful. And then Mike mentions he likes the idea of taking, your stop up as your first target gets hit. It's all about paying for the trade, which is not technically, people get confused, paying for the commissions and the cost of the trade. It's paying for the emotion of the trade. It's
Yeah, yeah,
for,
yeah,
right, putting your damn feet up.
yeah. Yeah, so a lot of times, so I think hopefully somebody sees this, like, all right, so let's say you did, if you got in here, all right, if you saw this action and you were in right here, that you're in pretty quick. You get that first target, right? So 1T got hit. But if you're playing by the rules, you get taken out, okay? You're gonna get taken out, so you're gonna stop out, so you only got 1T. But it's still a good trade. I mean, this thing is still moving, and this should have convinced you that, oh, I need to try again, all right? For the way you could, so you can capitalize on this because you really wanted to see it get back up to here. That's part of the engagement. All right, you're looking to say, yeah, I know it's going to go up here. The market came back and got me out. Well, I got my scale,
Right.
but it came back and got me out. But it still looks good because this is what the markets do. They will continue to move this way, and then suddenly they will finally make the move up to where you think they're going to go, and you get back in and do another trade. So, unfortunately, see, this one I was just being honest. I missed that one, but that would have been that's a nice one right there. Like sometimes once you get in here and you get like your day, and you just sort of like you get a little bit more selective in terms of what you want to do.
Your opinion, the more correct you are with your opinion, the easier it is to find locations. The easier and better tools you have to find location, the easier you could trade your opinion. And so it's like there's that two-sidedness of direction and location. So even if you get your first target, you don't always have to pull your stop up to break even. You could just risk less.
Yeah, that happened. Yeah, you can do that too.
So then you're, risk less. And whatever, again, going to the word that Peter just used, comfortable. Everybody's that's why nobody could trade exactly the same, because everybody's comfort level is different. Goals are different, risk tolerance is different, hair is different, everything is different. But that's the fallacy a lot of people have when they join is when I say join, when they get into trading, is trading too much exactly like somebody else. But you got to get that, hey, you're bullish. In fact, let me see if this works. I'm going to ask you to be able to, actually, you guys see that yellow pen or no?
Yeah.
Oh, good. Watch this. So the key is, just to recap what he said, is he got bullish after seeing that price action. He wasn't long. It'd been great to be long in here.
Hell yeah.
Already, but he didn't see this before it happens. And that's the key, is like, okay, well, so he sees it, he gets bullish. He's absolutely dead right not to try to buy it in there because it's a small pullback and it's almost to your FOMO. That's a breakout trade, fair missing out trade if you buy it in here. It's not really much of a retracement. He wants a pullback, something deep or deeper, but not too, so boom, he gets it, sees the price action, hops on board, bam, everything else falls into place. Not that the trade worked, but that his process worked. Boom, he covers his risk, covers his scales, and then manages. Risk, scale, manage. And you notice how his risk is first? That was the other thing. I'm writing notes on what you said, so I could just look at this and say, I just put important. When you say something, when someone I'm listening to says something again, generally that's important. And you said it, know your risk. And then when you started, the first question you had was, where's your risk? So before he even thought of entry, before he tried to see the flow, know your risk. There you go.
Yeah, I think it's, if you can, you have to think like, I'm wrong under here. I'm wrong under here. Can't be thinking like, oh, it's going up there. It's going up there. What I have found personally, when I start thinking it's going up there, is that I'm chasing, right? And then I get just disappointed when it doesn't go up there. So I want to find out, where am I wrong at? Where would I be wrong on this here? That's what I'm thinking. So I think it's going up there, but where am I wrong at first? So you have to look. You have to think about that, and I think that'll kind of keep you out of trouble.
First thing I learned, first class, know where you're getting out before you get in. For a loser. I walked in, that's what he said. Any other questions? By the way, Peter, this is great, man. This is nice, clear, to the point. Everybody loves it that are commenting except Carl. And you just don't know where Carl lands.
Yeah, I could just see Carl up there at the pitcher's mound. Instead of Fauci, it being Carl up there, it would have been equally
Same result.
same result. Far left, not even in the same ballpark.
No, that would be funny. We got to get Peter, or we got to get Carl on a YouTube video, 6 feet 6 inches, trying to make a throw. Let's see where it comes. Well, you know what? He might have been pretty athletic in his defense. We don't know.
I think he was. Yes, he was.
But man, if Fauci knew he couldn't throw, he should have never agreed to do that, or got closer, or practiced.
Right.
I mean, come on, you didn't. But you could tell his throwing motion was
right.
That of someone who was like a lefty trying to throw righty.
Yeah.
Charles, now you know where I come from. This is what I got to read every day.
Oh, horseshoes and hand grenades, Carl. Almost.
He said he almost played pro ball. He had a hard time throwing, hitting, and catching. But if he got over that, he'd have been good. It's about the 13th time he's used that joke in my relationship with him. So, all right.
That's good. Hope everybody enjoyed.
They did. Well, you could see the comments. I don't have to read them to you. But that's awesome. So, and then Peter's in the team room daily, right? And you log into my room and the team room at the same time every day.
Yep. Yeah. I'm a glutton for punishment.
But so people that are going in the team room, they already know a lot about Peter. And so that's a fun environment. It really is. And it's like, tell people how you've enjoyed it. Like, what do you like about it?
Well, this is a lonely business. If you're doing this from like a home office. I do this from my home. I don't have an office downtown, or I didn't rent out a suite someplace and do this. It's trying to keep, this is like an expense business where you got to keep your fixed expenses as fixed costs as low as possible. So I do this from a home office that I set up, and the tea room it's a great way to share some ideas, get some different perspectives, and then just to talk to people, just to talk to a few people. And because you had that seminar, I made it to one of your seminars. It was great, actually, shaking hands, and then created some friendships. I have a couple of guys here. We get together a couple times a year, at least once or twice a year, and we're getting together tomorrow. In fact, a couple of us are going out to Phoenix and doing a little racing school.
That's cool. Well, that's what's important. It's connectivity with people. There's 2 steps to it: being connected to people that you like. And so a lot of people think that there's different connections with social media and forums and things like that. You got to be able to humanize every experience by talking and listening, creating relationships. And that's one of the things I always say I'm most proud of in this whole Edge thing, is the relationships that have formed where these guys now travel together. A lot of their families know each other. But it's not just talking to people and being in an environment, but it's with people you like. It motivates you to continue to move and to go. And even if you had an office somewhere else and whatnot, it's not just being around people in that office, but people that you like. Without it, man, even if you're crushing it, it'll get boring quickly. And you're not going to crush it from 0 to 100. You're going to have down days, down weeks, down run. You know what I mean? You still need
Yeah.
connection,
Yeah.
no matter how great you might be.
Totally. I mean, there's a big thing, and we can see it right now with this, with the pandemic. There's a lot of concern about, kids being separated from other kids, and also about people just, in a work environment, not being, in an environment where they're around other people. There's a lot of, there's some despair that can, you can generate a fair amount of despair, and you get a little bit of that isolation thing going on, and it can screw with your mind, make you do things you shouldn't be doing. So probably one of the other advantages of the team room, I think, is it helps slow me down sometimes and not do things I shouldn't be doing, because it gets me thinking a little bit, and then you get other people online too. So um, it's a good support mechanism.
I just put this whiteboard is there's no doubt you got to be with other people and then be able to have the people that you kind of like and then go from there. So thanks again, Peter. This was better than I knew it was going to be good, and was even better than that. So that's cool, man. We appreciate you coming in and doing
No
this.
worries. Thanks for asking me.
Yeah, my pleasure. We'll see you tomorrow, and most of you either tomorrow or next week at this session. And that's it. I'm going to stop the recording for those that are listening. That'll end right now.